All right, everyone. Welcome to another episode of Upstream with RiverX. I'm your host, Kieran Berry, and today I'm joined by Craig and Reuben from Pallas Capital. And before we kick off, it's important that we cover our disclaimer. Anything that we say on this podcast is for entertainment and information purposes only. If you require advice, please sit down with a financial advisor. Any information here is general in nature, so please reach out to us. We have a team of professionals at RiverX, and we can provide advice if you need it. But without further ado, welcome, Reuben.
Thank you.
Welcome,
Thanks
Craig.
for having us.
Thank you. I'll try to make this entertaining then.
Thank you very much. Yeah. Well, gents, just for a bit of colour, I might start off with you, Craig. A lot of people are familiar with the name Pallas Capital, but they might not be familiar with the people behind it. So could you give our listeners a bit of context about your role in the business and your background before you joined Pallas?
So the Pallas business started almost 10 years ago. 2015, 2016 was the nucleus of it. There, back then, 5 owner-directors. 3 of them, the other 2, myself and one other, we've worked together since the mid-1990s. So we were in financial services. I was up in Singapore for 20 years, and the other 2 guys were international based as well. So that history of just knowing each other for a long time led us into 2016, and the formation of Pallas was with those 3 plus 2 other gentlemen that were experts in property. We've got Dan Gallen and Charles Mellick joined the 5, and that started the business. So we started with an idea of a development company called Fortis, which is today building out over 30 odd projects, Sydney, Melbourne, Brisbane based, and then Pallas Capital, the non-bank lender, which has now done over $8 billion of lending across 1,000 transactions. Mm-hmm. So from those 2, early days in 2015-16, these 2 businesses have grown up, and it's been a great business to be a part of.
And how many staff do you have now? So you've got quite a big team, and we see the Pallas name everywhere around Sydney's eastern suburbs. So you must have quite a presence down there as well.
Yeah, it's about 200 odd people now, split between the development side, Fortis, and there's about 65 people in Fortis and about 140 odd in Pallas Capital. So when you break that down, Fortis, importantly for people, is a development manager. So they probably misconstrue Fortis to be a developer, which is natural because you see all these hoardings around the build sites that says developed by Fortis, but they're a development manager, which basically means they're a fee-for-service business. They don't own the underlying property. The underlying property is actually owned by the directors of Pallas Group, and then we appoint Fortis to be our development manager. And then on the Pallas Capital side, the team, the big parts, the big engines of that business, credit and loan management. So we've got our credit team. Now they're probably about 40 odd people in strength, experts in construction finance, in pre-development, in understanding the risks associated with lending in commercial real estate debt. So that's about 40 odd. There's a team of originators that are out there sourcing new loans, about 15 people. And then there's our distribution side, which I'm heading up, and that's about 25 people now that are looking for new investors to come through, high net worth, family offices, wealth advisory groups. Mm-hmm. So
that's how we've been connected with Reuben, funnily enough. And Reuben, you're part of the distribution team, if I'm not wrong.
Yeah, absolutely. Lead the wealth team for the Pallas Capital business.
And so how long have you been with Pallas now?
It's been 3 years now.
Mm-hmm. And so before Pallas, where were you? Like, what was your background before joining the team?
Absolutely. 25 years in, 15 years in financial services. Started out in Macquarie, in the bank. Spent about 6 or 7 years up there doing more product-related roles, and then moved into the dark side, the sales side. Worked at businesses, Unpack Asset Management, Evans and Partners, set up my own startup, fintech startup, and then moved to Qualitas and did 2 years and headed up their wealth area there at Qualitas, and started then at Pallas Group 3 years ago.
So that grounding in wealth would give you a good sense of what the wealth management businesses are looking for in a provider like Pallas, and is that why you're heading up the wealth division? Does that mean you're just dealing with the wealth advisory businesses that invest with Pallas?
Absolutely. Look, I think when it comes to this asset class, there's 300, 400 lenders in the market. It's very fragmented. And there's a number of them doing a number of opportunities across the risk spectrum, from $1 million loans to $150 million loans. If you're a financial planner, wealth manager, how do you pick the best manager? I think it's all about working with the right teams, figuring out who has the best opportunities out there in the market, who has the institutional capital, and things like that. And that's what I'm trying to facilitate and create and bring to market.
And one of the things we did recently is we hosted you in our boardroom and introduced you to our advisors, and we had a very informative session about the genesis of the business and where you're at today. Craig, what do you think it is that sets Pallas apart, and I guess your point of difference in the market and why people come to invest with Pallas over any other third-party lender?
There's a couple of things there. The biggest thing, I was working with a group recently and they were coming into this space. They were setting up a new credit fund, and it was $1 billion credit fund, and they looked at this 300 odd providers in the marketplace, and they went, how do we start to choose? How do we pick it? And they broke it down into subsectors, and this is for any probably wealth advisor to pick the investment managers. First thing was they looked at, do they have any institutional backing? So where's their capital coming from? Is it just simply high net worth investors? Well, that can be flaky if the market falls and equities take a tumble, then those investors will flee. So you need institutional backing to really be a serious lender in the marketplace. Then they looked at credit. Who's heading the credit? What's the credit risk and compliance teams like? Are they experienced? And these points then come into this factor that we've got institutional backing through Goldman's, Ares, Westpac, and these institutional lenders are looking for that type of credit risk officers, compliance. What's the team look like behind the doors? And so, I look at Pallas, the growth that we've had has just been step by step. We've increased the business in certain ways. We've added on experts in credit, in risk, and now we've got a fairly formidable team that when you put it up against the other non-bank lenders, stands up in the top 10 of the country sort of thing. So I think that's, differentiation then comes down to the manager in what do they specialise in. And for Pallas, it's loans that are between 3 and 30 million in size. Other lenders would be $30 million minimum up to hundreds of millions. Mm-hmm. So there's nuances in where you lend, the type of asset that you lend. We're fairly generic in that we lend commercial real estate debt lending, but that term confuses some people sometimes because it can be we're lending commercial loan to a borrower, a developer, building residential apartments. So we do a lot of resi lending, but it's to a commercial borrower. Mm-hmm. So a big part of our loan book, we are concentrated in Sydney, Melbourne, Brisbane, inner city development areas, and we're looking for developers that are buying an asset to redevelop it into a higher, better use. Mm-hmm. And that's our knitting. That's what we're sticking to. So we could say what we don't do is we don't lend out into big growth corridors, southwest of Sydney, western suburbs of Melbourne. We're not big in that area. There are other lenders that specialise in probably vacant land lending. We're much more inner city type areas.
Mm. I think one thing that I would know from travelling and dining around the east is the transformation that we've seen in the Double Bay precinct in particular, and that would be some of your landmark projects that I would think. Can you just talk to, I guess, sort of the business? I know you started with some of those projects back in 2016 with Fortis. Is that what enabled you to tap into the high net worth market because they were familiar with those projects and then move into the institutional market? Or what would you put it down to in terms of giving Pallas the success that it's enjoyed today?
Yeah, Pallas and Fortis are obviously intrinsically linked. The Fortis product is a luxury high-end apartment development, which has been built in Sydney, Melbourne, eastern suburbs of both cities. We started with residential. 2016 was Fortis's first development down in Melbourne. So there was 2 or 3 resi. Then in 2019, 2020, we bought the first commercial site in Double Bay. And that's now Pallas House, where we've got Margaret's down below, and we live up top on level 4 and 5. So that's the first commercial building. And then Charles Mellick, head of Fortis, looked at this and said, we could start to really change the fabric of Double Bay. If we brought in these commercial offices, brings life into the area. It was getting to be a little bit of an old age retirement home that was just expensive down there. And the life. Now we've got these commercial buildings that are coming through with bars, restaurants. There's life happening down in Double Bay, and It's transformed that area. So, that clientele that Pallas has gained has partly been because of the Fortis brand. The high-end sort of style of Fortis has lent us to looking for those types of investors under Pallas as well. So we do have a fairly blue chip, high-end, sophisticated investor behind Pallas. There's probably about 1,300 investors behind Pallas in total, and they would be generally, they're a well-heeled sort of blue chip eastern suburbs, northern beaches type investor. Melbourne would be eastern suburbs of Melbourne and Brisbane.
And then I think one of the main things that has gotten the market's attention has been the institutional backing that came next. Now, normally when you look at non-bank lenders, that's something that happens much later in the life of a business, but it seems to me that happened quite early in your journey, or comparatively early in your journey. What would you put it down to that's enabled you to sort of access that channel of capital so early in your journey?
You're absolutely right. That journey, 2016 to 2020 for us, was high net worth family offices. And at that point of time, a normal progression would have been us then branching out into the wealth advisories with a dedicated wealth type fund. We jumped that step by bringing in institutional capital from Credit Suisse. And it was a $580 million facility. It took us about a year to get it in place. It allowed us to lend or draw down from Credit Suisse money up to $7.5 million to fund pre-development loans. So it was a great tap to have. And it was a coup. It was a feather in our cap, because I look back at that point of time, I don't think we were 500 million under management. Today we're 3 billion. And we've got Credit Suisse to give us 500 million. So it wasn't normal. So it was a great outlier of trade. We did it because our chairman, Patrick Keenan, is a lawyer by background, an investment banker by background. He was able to sit with Credit Suisse, the international bank, and put that together. And now those facilities with those institutional banks coming through the non-bank lenders are more common. But back then, that was one of the first of its kind. So it was a bit groundbreaking. It put us on the map for sure. We jumped from probably a lesser known name to hang on, you've got institutional backing. This is serious.
Who are these guys? Yeah.
So really, jumped us up.
I would say, having dealt in the private credit market for several years now, that there was probably 4 or 5 providers that most people would have parked their capital with, and then Pallas was an emerging name. And then it was those institutional partnerships, I think, that probably got the market's attention, especially in the wealth space. But now we're just coming to that point now where you're starting to create special facilities for the wealth market. And that's one of the things that we've taken an interest in at RiverX. You've come up with PSIF, which is your Senior Income Fund, which is PSIF stands for Pallas Senior Income Fund, if I'm not wrong.
Yep.
Reuben, maybe can you tell us a little bit about the characteristics of that fund and I guess why it's starting to get some popularity and some momentum?
Absolutely. So the Pallas Senior Income Fund traditionally is for the wealth planner. It's our flagship conservative first mortgage fund. It has characteristics of monthly liquidity, no related party lending. It has characteristics of diversification through 177 loans, first mortgage loans into the portfolio. It also has the 66 or 65 LVR maximum average, which enables us to have a very well diversified count when it comes to the Pallas Senior Income Fund. There's a number of other characteristics. It has the enablement to invest alongside the institutional mandates with Goldman's, Ares, Westpac Institutional Bank. We'll come to that a little bit later on how that benefits the fund, but also has and takes interest in first mortgage SPV loans as well, and good quality ones as well.
One of the things I noticed is I think you're enabled on almost every platform now. You got Premium, Hub, was it Net Wealth, BT, are you on Macquarie?
Very soon to be on Macquarie. Yeah, that's the only one.
So you basically would appeal to those firms that have the open architecture
absolutely
in the market, so that way they can access you from any channel. It's daily applications, monthly liquidity. Is that right?
Absolutely, and that's the difference between a lot of other managers in the market. A lot of them are monthly priced. We're daily priced, and that's the benefit. If you want to put in $1 today, you get interest starting from tomorrow.
Okay, so with daily pricing, let's say I put an order in on Premium, which is the platform I'm fairly familiar with. I'm using their custody-based solution, which is the Premium SMA. And a client says to me, I want to put $500,000 into the fund tomorrow. You're suggesting that it's a daily application, so that means we start accruing interest right away rather than having to wait for the next period, which can often leave the client waiting for more than 30 days.
Absolutely.
It could be a 6-week wait for them to get into the next month.
Yes.
So that means they get the benefit of that accrual straight away.
Yep.
Now, in terms of the yield profile of the fund, I think I saw you guys are sitting at about 10.1 at the moment on an annualized basis. And how does that stack compared to some of your peers in the space?
Yeah, absolutely. Look, that 10.1 is annualized over a 12-month period. So just to give you a little bit of basis, when we started the fund, we actually had a lower exposure to our institutional facilities. We had a number of SPVs, which allowed us to have a lot more alpha within the fund through that. We then decided, or the portfolio manager, Dan Gallen, decided the leverage of the institutional capabilities that we have will have a reduced effect on the return, but be a lot more risk adjusted for clients' returns. So right now we're performing around the 1.1% mark, which is around 100 basis points thereabouts above the target of 5 plus the RBA. We should expect to be around 20 to 25% above the target of 5 plus the RBA. Compared to our peers right now, we're certainly outperforming a number of our peers. Generally speaking, our peers are around the 9 to 10, more around the 9.5% mark. But again, it comes back to what's in that portfolio. And, when urging, speaking to other managers, finding out what's underneath the bonnet, a lot of our loans are inner city, metro, not in the city, versus not anything regional or anything like that. So I think from our perspective, I think from a risk-adjusted point of view, performing very well.
And I guess one of the main things that's hit the press of late has really been about the visibility of the underlying loans and how they're performing. If an investor was to come to you and want to have a look at the loan book, how does that work? Is that all within a monthly report or some sort of a PDS document that you issue them when they look to invest with you? How does that work? Do they just contact Pallas to get that information directly?
Yeah, absolutely. Contact your advisor who has access to not only the IM, but a monthly report, which sets out exactly what the manager commentary is, investment for the month, and all the bits and bobs of what's underneath the bottom of the fund, and that's what we provide to the advisor, but also to end clients as well.
I think one of the main benefits of PCIF, from my perspective, right now there's 175 loans that PCIF has exposure to, first mortgage loans, but 165 of those loans are through the 3 institutional facilities: the Goldman's facility, the Westpac New Zealand, and the other. We have a tier 2 Australian bank. We can't name them for that they've said they don't want to be named, but they're a tier 2 Australian bank, and we can do construction lending under that facility. So of the 175 loans that PCIF has, 165 are look-through loans into those 3 facilities. The other 9 or so are direct single asset loans that PCIF holds. Now, if any of those loans in the institutional facilities go into a default situation, then the investment manager of those loans, of those portfolios, has to take that defaulted loan out of that institutional facility. It'll either get refinanced out to another non-bank lender, or we have a high yield fund that we could take a defaulted loan and put it into the high yield fund. It pays 15 or 16%, and that's the purpose of it. It can take high risk loans. But we come back to PCIF's exposure. If the insto has a loan that goes into a default, it has to get taken out within a 15-day period after the actual defaulted period's known. So PCIF should operate with a very clean loan book, that if a loan does go into default, and default could be all sorts of things, like it's generally not because it's missed a payment. That's because these things are prepaid interest under those types of pre-development loans. It could be that it's gone over the term of the initial loan. So it's a default under that. It could be that it's missed under a construction contract, that it's missed a milestone like a pre-sale milestone, or it hasn't started or it hasn't achieved a certain progress. These are all little defaults that might happen under the loan terms, and it allows us, being the investment manager, to maybe move a loan out of that portfolio.
So that from a risk-adjusted return perspective, it's quite strong, getting the 10.1 by mitigating that risk within your loan book. Have you seen any drawdowns since inception of PCIF? I know it's a relatively short time frame for the fund, but I imagine
the fund's got a 5% monthly drawdown. I think the most I've ever seen is a 1% on one of the months.
Yeah.
So,
but 1% on the return for the month. That means that you're, in terms of...
Oh, sorry, no, an actual redemption.
You're talking about redemption. I'm speaking about a drawdown in performance. So when you're looking at the fund's return, it might be generating you 70 or 80 basis points a month to get you your 10 to 10.1. I'm saying, are you seeing any drawdowns in performance because of loan book quality? I'd imagine it would be pretty steady.
Yep.
No
pretty steady. In terms of any drawdowns, we've been pretty consistent with the return. As mentioned before, we moved from having a higher percentage of SPVs versus install funding, and now we've reversed that. So we should expect to see 60% pool lender exposure, which is consistently performing in that way. So in terms of any drawdowns, absolutely not.
So I also think you've had about 75 basis points of rate cuts since we started the fund. So that 10.1 is on an annualised 12-month basis. Current month, like last month, was 9.31.
Yep.
But with those 75 basis points cuts before, that would have been up around the 10%.
Yeah.
So we're probably going to be maybe a forward-looking 12-month if rates stay here, which is they're probably going to drop further. But we're probably at 9.3-ish right now, and that'll probably carry on with a drop-off if you get more interest rate cuts coming through.
So the market is expecting more rate cuts, and you've got a team of professionals that provide you with forecasts and outlooks. Where do you see rate cuts going over the next 6-12 months?
It's interesting, isn't it? We had an economist talk recently, and that economist had RBA rate cuts down to 1.5 at cash rate, and everyone in the room went, "Oh, that's crazy! It's not going to get down to that level." So from where we are now at 3.6 to 1.5, who knows? It's a tough one to really forecast how far we're going to go, because there's so much global issues, and Trump's tariff policies are front and center at that. Where's that going to go? Heard people say it's inflationary, and others are saying it's deflationary. If America throws up all the tariff policies, then is China going to flood us with their offshoots that they can't get into America? Quite possibly. I've seen more BYD cars on the roads in the last 3 months than I've ever seen. So it could be that Trump's tariff policies become deflationary for Australia. So it's hard to say where it's going to get to, but my personal thing is around 3% by the end of the year. We could get another 50 basis point cuts.
Yeah, we're expecting that, which will be frothy for certain asset classes and a slight negative for others. So in terms of your total performance, we'd expect to see that drop by a consummate amount in terms of where the rate cuts are. But then
I could see that's ultimately what we're dealing with. We're dealing with borrowers that are developers that are taking money from us, and certainly the recent cuts it's a bit like that balloon was so far expanded back in 23, 24 that it wasn't bursting, but it was getting pretty full. Had rates gone further, things would have started to pop maybe. It didn't. We didn't have any loans that went into an impairment during that stage. We had loans that were in default because we had construction costs flying through the roof, and so loans weren't sitting at their 65 LVR. So we had defaulted loans, but they weren't leading into impairments. The good part about what we've had over the last 6-9 months is that these rates have come back. Those borrowers have got a little bit more breathing room. Their financing costs have come down, and they're ultimately in a better position. We've also seen in our market all those construction costs start to flatline. We're not getting the huge increases now. There is cost inflation. You talk to the experts between 3 and 5%, which is normal. So, our loans are probably safer today than what they were 2 years ago. They definitely are. and a further rate cut or here or there will just reduce the overall risk from the borrower's perspective about defaulting under a loan. And I think with rate cuts coming through, it's obviously supporting the property market. And a lot of our loans are to developers building stock for apartments. So the uptake at the back end should be quite strong.
And do you provide exposure to any equity style investments, or is it all debt through Pallas?
No, we're through this tie-up with Fortis, we have direct exposure and direct investment opportunities for the investors into those Fortis projects. So it sits at a preferred equity level, and really what it is, it's us sharing in the development profits of each development as a standalone basis with investors. And so those returns can be anywhere from 12, 13%, depending if the asset's a completed asset and we might be holding it, versus up to 18% for full development risk, which is sort of getting in on an early stage project, seeing it pass DA, seeing it get through to construction, complete the asset, complete the development, whether it's a residential apartment building or commercial office space.
Do you see a change in terms of flow with your business? You know, when I'm saying flow of capital with inflows from people like us or high net worth investors when the rate environment moves. So when rates are lower, do you see more interest in the equity style investments because development risk is lower? Or do you see steady inflows into your private credit style facilities over the course of time?
It's been pretty steady. I wouldn't say one way or the other. The development projects through Fortis do pay fixed returns. So they're sort of a 6% fixed coupon with a 8% kicker or a 10% kicker at the back end. So they're fixed returns rather than the over BBSW over a fixed rate. But it's probably more, if I'd say inflows and outflows occur when times when markets were stressed. 2022 was a time of interest rates rose quickly. We saw that change. That was a tougher time to get investors coming through. We definitely benefit when money is freer, when stock markets are doing well, because people probably have excess cash that way. They're looking to invest. When markets are coming down, then they're tightening their belt. In saying that, we're a defensive asset class. If stocks fall 20, 30%, we would still be performing under senior debt and returning just under, PCF will return 9.3%. It shouldn't have a loss in there. Whilst those equity markets can suffer losses that way, we have this great equity buffer between each loan. We have a 30-odd% equity buffer.
And if that's the case, like the market is an unpredictable place, and we've seen overnight a bit of volatility with tariff concerns, exactly what you've mentioned before. One of the hottest things that's come to market of late has been the listed investment trust vehicle. And that's been one of the ways that big providers, some with varied success, have come to market to get access to more capital. What is your view on the listed investment trust market? Is that something that Pallas would ever look at, or is that something that's just not of interest because you guys have done so well privately with your high net worth networks?
I think it's always of interest because it's a different source of funding that you could generate. So we haven't done one yet. Of course, we've got the varied, for us, it's high net worth family office, wealth advisory groups, and the institutional money. The natural progression would be some sort of listed entity or listed fund for us next. So it's probably on the cards, but no timing from us at this stage.
Yeah, I think it's quite interesting because it's drawn the attention, certainly of the business media in terms of the underlying investments and getting more visibility over the loans. But we've seen some be really successful. Like I think Realm did a great job on their new issuance when they came to market, but we've seen other issuers really struggle to hit the mark in terms of the capital raising. So timing will be key, but I think there'll be a lot of people keeping an eye out on how to access these type of funds in the public domain from a liquidity standpoint.
My view on that as well is I think when you try to create liquidity in an environment where you can't back it with maybe a distribution team going out there to prop up the price, you rely on potential heavy discounts if volatility is there in equity markets. We saw that with a number of LITs, in 2020, some 40% discounts. You saw some relist and or delist, I should say, and convert back to equity just because they couldn't or unlisted because they just couldn't do it. So I think having those initial instruments in there, buyback opportunities, or having a term trade for that, I think would definitely prop up the market.
Well, guys, it's been great to learn about Pallas. If someone wants to find you, maybe the distribution team can let us know. Where do they find you? Must they go through a wealth advisory team, or can they come direct and make investments with Pallas?
No, absolutely. Look, they can absolutely come to our website, put in a submission. But we're working with a lot of financial advisory firms that do the due diligence on all product manufacturers. So obviously we do take it in clients that come direct to us. But there are good advisory firms that we work with. So happy to work with them as well.
Yeah, in terms of our business, we've put PSIF to our investment committee. It's been looked at by internal and external members of the committee. So we're happy to sort of have that on our APL now, which is great to kickstart our relationship officially, even though we've had an unofficial relationship with Reuben for some time. But we're certainly happy to be working alongside of you and getting some good outcomes for our clients. So thank you very much for the success so far. Is there anything else you guys like to share with our clients or audience before we clock off?
It's all good.
All right, fantastic.
All right, guys. Thanks so
man.
much.
Cheers. Thank you very much.
Thank you very much.